So we will continue our discussion on economy. We are in the module monetary system, and in the previous session we have talked about different quantitative measures of monetary policy. We have discussed about CRR, we have discussed about SLR, we have discussed about bank rate and liquidity adjustment facility. We have discussed about repo rate, and we have discussed about reverse repo rate, rather repo transactions and reverse repo transactions. Now, what is CRR? CRR is the percentage of NDTL of the bank that banks have to maintain or keep with RBI in the form of cash at any point of time. So CRR is the cash which has to be kept with RBI by the banks, and usually no interest is paid on this. And what is SLR? SLR is also a percentage of NDTL, that is a net demand time liability of the bank, that the banks have to keep with themselves, okay, to meet the immediate liquidity crunch and everything. Okay, so that has to be maintained in three forms in general: cash, gold and government securities. But bank prefer government securities because cash you won't get any return, it will be idle, and gold, even though more return is there, but it will be there only if you calculated the market rate. But in case of gold, it is calculated on the base of a constant price or a base price. So even if you keep it in terms of gold, the return is actually less. It is actually done to prevent the import of gold. Okay, and mostly you will keep it in the form of government security so that you get some return like 7%, 8%, 6% interest you get. Okay, now what is bank rate? Bank rate is the interest rate, the rate of interest at which the banks can borrow from RBI against or by pledging the first class securities. And I've told you what you mean by first class securities. These are the private or non-government securities. Okay, these are issued at a discount, and I've told you what is discount, and RBI will give you the rediscounting facility. So upon this first class securities, for example, commercial paper in case of high net worth companies, or commercial bill in case of small companies, you can issue the securities and you can get money from banks. Banks can pledge this, and banks can borrow from RBI. That rate of interest is what? Bank rate. Okay, and reverse repo and repo we have discussed. Repo rate, banks can borrow by pledging the government security. Okay, so here in repo rate, the government security is what pledging. In bank rate, the first class security or the non-governmental security is what they are pledging. So the only difference in case of these two is both are instruments used by banks to borrow from RBI, but in case of bank rate, it is first class securities, that means non-government securities. But in case of repo rate, it is government securities. Which one is more secure, more safe? Government securities is more safe. So the interest rate under repo rate is less compared to bank rate. Okay, and I have told you, usually nowadays RBI will only announce the policy rate, that is a repo rate, and everything else is connected with this policy rate. So bank rate will be slightly higher, okay, because you are pledging first class security. Repo rate will be slightly lower because you are pledging the better security. Also, if you are pledging the government security, your SLR will be affected, right? So no, you cannot actually pledge the government security if you cannot meet enough SLR requirements. Only after you have excess government security you can borrow under repo. If you don't have excess government security, you cannot borrow, because anyway you have to meet the mandatory statutory liquidity ratio. Only after that you can borrow under repo. So if banks have extra government security, then only banks can go and borrow under repo. If banks don't have, then bank rate. Okay, now reverse repo, it is the opposite, the rate of interest at which you can interpret in two ways: either RBI borrow from banks or banks keep the money with RBI. The second one is better because RBI don't want to borrow from banks logically. Okay, but somebody somewhere sometime to make students understand all this, and from there onwards it is it is told like that, RBI borrow from banks. Okay, so we have to change it. That is not required. RBI don't want to borrow from banks. It is a rate of interest at which actually banks deposit money, or banks keep their money with RBI, or banks buy government security from RBI. It is the reverse, and I've explained this. Okay, what is actually happening here? So this is reverse repo. RBI will sell the securities to banks, We can see here RBI sell securities to bank, and banks will give rupee to RBI, or banks keep rupee with RBI at an agreement that the RBI will buy them back, so buy back, and will return the money. Exactly opposite of repo. Repo, here you can see banks will buy, or RBI buy from bank, okay, and give money in return to bank with an agreement of selling it back to banks, and banks have to return the money. So this is what we have done so far. Now in this session we will be talking about marginal standing facility, and we will complete that, qualitative measures also. Okay, so it was introduced in 2011, marginal standing facility, introduced in 2011. So it's actually an overdraft facility. The limit is actually fixed, and it is on the basis of daily interest. So here under MSF, banks can borrow from RBI up to certain percentage, currently 2%, okay, 2% of their NDTL on overnight basis. Okay, so interest is on daily basis. Okay, now here also banks pledge government security. Now then, what is the difference between repo and MSF? Repo also banks can borrow by pledging government security. Here also banks can borrow by pledging government security. The difference is when can you borrow? If you have excess government securities after meeting the SLR, okay, statutory liquidity ratio. But here, even if you don't have excess government securities, even if the government securities are part of SLR, you can pledge that and you can borrow under MSF. There is a short-term facility, daily basis, overnight basis, overdraft facility. So you can pledge those securities which are there part of SLR also. Or rather, I put it in this way, even if you pledge that under MSF, it will be counted in SLR. But in case of repo, if you pledge the government securities, it will not be counted in the SLR. So MSF and the repo, the difference is, in case of MSF, some relaxation is there. That means if you pledge in RBI, still it is counted in SLR. Here, in case of repo, okay, even if you pledge with RBI, it won't be counted in SLR. So that is the difference. Otherwise, both are the rate of interest at which banks borrow by pledging government security. In both cases, banks borrow. In both cases, government security. But in case of repo, the government securities which is pledged won't count in SLR. But in MSF, the government securities which is pledged with RBI will be counted in SLR. So that is the difference. So where you see flexibility, the flexibility you can see in MSF because it is counted in SLR. So if both interests are same, now technically or logically speaking, both interests are same, which one banks will prefer? Which one? Banks will prefer MSF. Why? Because you can pledge the government security, at the same time it will be counted in SLR. So do you think that both interests will be same? No. Some flexibility will be given to repo because repo is slightly rigid. There is no compromise. Here some in case of MSF, some leniency is there, or some flexibility is there. So slightly the interest will be more. So some extra will be there. So banks will fix the repo rate, as I've told you, policy rate 0.25 basis point or 0.5 basis point will be the the MSF. Okay. So MSF will be policy rate, that is the repo rate will be fixed plus 0.25 basis point. Now this, when I'm talking about this 0.25 basis points, or before it was 0.5 basis points, the number is not important because when the time I'm recording this video and when it is aired, it will be entirely different. Okay, so maybe different, not necessarily, maybe different. So banks can pledge the government security, it won't affect the SLR, won't affect SLR. Okay, same in case of repo, but will affect SLR in case of repo. Now, why it is introduced? Why it is introduced? Okay, see, till then banks had two options to borrow. Either you can borrow under bank rate or you can borrow under repo rate. See, bank rate, it's actually the discretion of the Reserve Bank to lend money or not, right? If the RBI's objective is to reduce money supply, bank rate, RBI won't lend. It is a discretion of RBI. So banks are not able to get money under bank rate. It is a discretion of the RBI. Now, reverse repo, you can borrow only if you have enough government security, excess government security. So here also some banks will face problem. So banks are not able to meet their liquidity crisis with these two instruments. So MSF was introduced. Under MSF, you can borrow overnight basis, daily basis, interest is charged under or by pledging the government securities, and it will also be counted in SLR. So that means even if you don't have excess government securities, still you can borrow from RBI, maybe 0.25 extra percentage point interest you need to pay compared to repo. You can't borrow under repo. Why you can't borrow under repo? You don't have excess, excess government security. If you have excess government security, you only prefer repo. If you don't have excess government security, you have other option as bank rate. It is a discretion of RBI. If you are not getting under that, now you have a choice. So I hope you understood this. But there is a limit. You can't borrow too much. You can have only 2%. Earlier it was 1%. Now it is 2%. It is so small, right? 2% of NDTL. That's why we call it as marginal standing facility. Okay. So the difference between repo rate and MSF you understood. Now what is their common or difference between MSF and bank rate? See, between this repo rate and MSF, I hope you understood clearly. Repo rate will affect SLR. Will affect SLR. Here won't affect SLR. Okay. What is common in both? GSEC, GSEC. Now what is common in bank rate and MSF? Both won't affect SLR. Why? Here it won't affect SLR even if you are pledging the government security. Here you are pledging the first class security. So no way it is going to affect the SLR. And here security is first class securities, non-government securities. Okay, non-government securities. So this is how these three. Next is market stabilization scheme. Market stabilization scheme, MSS. It was initiated in 2004. I'll tell you what is it. RBI will buy bonds, RBI will sell bonds. That is what actually the transaction happen. RBI buying means what will happen? RBI buying means RBI will pump money into the economy. So RBI selling means RBI will suck out the money from the economy. So you can see here when we started with see here, if this is this T1 to T2, this time gap, if you see, what RBI need to do? Infuse money supply. So infuse money supply means pump money. Pump money means RBI buy back the bonds. So give money. Now here excess money supply. So what RBI need to do? Suck out money. Suck out money means sell the bonds and take the money from the market. So this is what actually done in case of open market market stabilization scheme. Under MSS, RBI sells special government securities to suck out extra liquidity. That means simple money supply created due to the increase of forex reserve. So now I've told you post reform era, the reasons for increase in money supply is actually increase of forex. Pre-reform period, it was because of deficit financing. Post-reform period, increase in forex. Forex is coming means equal amount of money is printed and circulated in the market. So money supply is increasing when the forex is coming. So incoming of forex is also one of the reasons for increasing money supply, increasing demand and inflation. Okay, all these are connected. All these are discussed already. So I'm not getting into that. So to suck out the extra liquidity, to sterilize their inflationary impact. I'm not writing this. The funds raised through sale of such bonds or GSEC are kept in a separate fund with RBI. Why it is done? It is basically done to reduce money supply. Now we have done with quantitative measures. Now we will move to qualitative measures. Qualitative measures. So these are specific measures. Before we have seen quantitative general measures. Now we'll see specific measures in different sectors. So this is not going to affect the overall money supply like what we have seen in case of quantitative. That will affect the overall money supply. If you need to increase the money supply, reduce all the rates. If you need to decrease the money supply, increase all the rates. We have discussed that already. Now here what we need to do is, this is not going to affect the overall money supply. Rather, money will be diverted from one sector to the other, like agriculture sector, industry sector. All this diversion is what you can see. Okay, priority sectors, etc. That's why it is, specific or selective measures. Selective measures. So first one, credit rationing. Credit rationing. Okay, credit rationing means nothing but fixing the quota. Okay, so under this central bank fixes quota of credit for various sectors of economy. For example, priority sector lending. Okay, so what are the priority sectors? Priority sectors: agriculture, education, housing. Okay, so agriculture, weaker section. Okay, MSMEs, house loans up to 25 lakhs. Okay, house loans up to 25 lakh. Okay, education, etc. So when this priority sector lending was introduced, it was introduced in 1972. Now how much you have to give? You have to give at least 40%. So less 40% minimum you should give to the priority sector. So 40% of the NDTL. Okay, or rather ANBC is what you call as technically ANBC. ANBC is nothing but adjusted net bank credit. Adjusted net bank credit. Now within this there are some sub-quotas that also you need to know. Sub-quota like agriculture, at least 18% of ANBC. Okay, weaker section, at least 10% of ANBC. ANBC means adjusted net bank credit. Okay, within this 18% itself, 8% to small and marginal farmers up to 2 hectares of land. Small and marginal farmers up to 2 hectares of land. Okay, then what about foreign banks? In case of foreign banks, if branches are more than 20, okay, in India, if they have more than 20 branches in India, then 40% of ANBC, and if branches are less than 20, then you have 32% of ANBC. It will be increased to 40 by 2020. Okay, see, 7-8 years back it was 32% for both. Okay, all the foreign banks it was 32%, and for Indian banks it was 40, as we have already discussed, but it was increased to 40%, and by 2020 this also will be increased to 40%. Okay, so next is margin requirements. Margin requirements. So margin requirement means if you need to borrow, for example, if you need to borrow 10 lakh from banks, or 1 lakh, the collateral required may be 1.25 lakh or 1.5 lakh or 2 lakh. So that margin will be reduced. Like if you need to borrow for 1 lakh, you need to pledge 1 lakh worth things, so that you can give money to more people, more weaker sections, etc. Okay, those people who don't have enough collateral, this may help. That is the idea. So it is the difference between market value of a collateral security and the maximum amount of loan that can be sanctioned by a bank against it in a particular sector. Okay, so as I've told you, if collateral is 1.2 lakh or 1.5 lakh, loan 1 lakh. Okay, so this is what margin requirement, this difference between market value and the loan, this is what the margin requirement. Now it will vary from sector to sector. So here you can see it is 20%. Here 20% is the margin requirement. So RBI can tell 10% or 5%, etc. So in that case, 1 lakh loan, you may need 1.05 lakh worth collateral. So you can get more loans faster. Okay, so if you need to divert fund to one sector, you can reduce the margin in that particular sector loans. So why it is done? To discourage money supply to a particular sector. Okay, so if RBI need to discourage money supply to one particular sector, RBI will increase the margin requirement. RBI want to increase money supply to a particular sector, RBI will decrease the margin requirement. So decreasing margin requirement means you can get loan faster and money supply will be there in that particular sector. Increasing margin requirement means getting loan will be slightly difficult, so reduce the money supply in that particular sector. So I hope you understood. To discourage money supply or to encourage money supply in particular sectors, this can be used. So that's why specific, sectoral. Okay. Third one, ceiling on credit. Ceiling on credit. So RBI fixes maximum amount of loans which can be given to a particular sector. So RBI can increase that ceiling in case of RBI want to give more fund to that particular sector. RBI can decrease the ceiling in case if RBI want to decrease money supply in that particular sector. So RBI fixes maximum amount of loan which can be provided to a unit in a particular sector by bank. Okay, so that is what third one. Fourth one, differential rate of interest. See, these are not that important, I'm just explaining. Like in case of quantitative, this is very important, always you get questions. So here, differential rate of interest. So as its name indicate, the different interest rates for different sectors. Okay, so central bank RBI prescribes different rates of interest for different sectors, different interest for different sectors. Then differential lending norms. Next one, differential lending norms, like the documentation which is required, the KYC norms. Okay, all this can be rigid in case RBI want to regulate money supply or discourage money supply to a particular sector. It can be flexible in case RBI want to pump money supply or increase money supply in a particular sector. For example, weaker sections, this can be the documentation can be flexible. And for maybe with Aadhaar card itself you will get loan, but it is difficult to get loan. But what I'm saying is this one measure, qualitative measure, differential lending norms. It is related to documentation. Then finally we will discuss about other measures. Apart from qualitative and quantitative, some other measures like moral suasion or basically moral pressure. So under this, central bank advises the banks to follow certain norms through their letters, speeches, etc. Okay, so under this, central bank advises banks to follow certain norms through letters, circulars, speeches, meetings, etc. Okay, so banks are not in compulsion to follow that. Banks are morally obliged to follow the norms of the RBI. So that is why moral pressure, not legal. Okay, so it can be quantitative as well as qualitative. So quantitative if it is in general, qualitative if it is in specific. Then direct action, like if the banks fail to follow any of the instructions given by RBI can take actions against the banks. Okay, so if banks fail to follow instructions given by RBI, it can take disciplinary action like penalty or sanctions, cancellation of licenses, etc. Okay, penalty, cancellation of licenses, etc. So this is what qualitative measures. So I hope you understood. We have done with monetary policy measures, quantitative as well as qualitative. I hope things are clear. If you have any doubt, you can get in touch with me here. This is my Instagram ID. You join the Telegram channel, you'll get all my videos over there.